If you think about the four major food groups of commercial real estate, the first in and the first out of any type of crisis is hospitality. And that's because their rents are adjusted every single day. They're renting rooms on a nightly basis and their rents move every single day. So hospitality is always the first in. It's always typically the first out. And it is in. And it went in at the very beginning of this crisis, and it will stay in for as long as this crisis is out there, and probably for quite some time on the backside until people feel comfortable traveling again and staying in hotels. So that sector has gotten absolutely smashed. Many owners of hotels have gone to their lenders and asked for forbearance. And in some instances, they've just given back the keys because they don't see any light at the end of the tunnel. But because the COVID-19 crisis seems to have a relatively defined sort of period, unlike most financial crises where you can't really look to the other side. Most people are sitting there saying 12 to 18 months and we sort of should be out of the crisis. And so if you think you've got staying power, there are people who've asked for forbearance from their lenders, and then they'll figure out where they are on the other side. Other people who don't see any visibility to their asset have already thrown the asset back to the lender. The next asset class that has been hit hardest by this is retail. Many of the retail centers that have movie theaters in them, have any kind of big box retailers, they've all been absolutely hammered. And interestingly, as it relates to retail, what you're seeing is the big chains, the credit tenants, are the ones who actually aren't paying rent or negotiating much, much lower rental payments than they're contractually obligated to do. And it's the, if you will, non-credit tenants or the mom and pop shops that are in these retail centers that are actually still paying because they want to get back to work immediately once this virus passes and there's sort of an all clear signal given, whatever that means. And then the second thing is that they don't have the leverage that the big box retailers have over the landlords. And so they're very afraid that if they don't pay their rent, they'll be out of the space and can't get back to work when this does clear. So retail, there's everything from regional malls that, or strip malls that have a grocery store that might still be operating. They might have a hardware store that's still operating because they are critical services. And then you go to the other extreme, which is a big box mall that has nothing but retail. There's nobody walking around the mall today. It's basically shut down and they're just bleeding. So that was number two in. Number three would be office. And it's interesting to say office is number three because you think about the long-term leases in office space. We're not seeing distress in office yet, but the questions about what office looks like on the other side of the crisis are clearly out there as it relates to, do people still need office space? Are people going to go back to working the way they used to work? And so I would just say that although we're not seeing any weakness in the office space today as far as defaults, I think that that's the third, if you will, weakest asset class right now as we are in this crisis. Then as it relates to the two asset classes that are showing strength, they are industrial, because the stay-at-home economy is requiring for Amazon and others to still distribute packages. And so industrial is held up very well. And then multifamily. And that's because A, people need to live somewhere, and B, because Fannie Mae, Freddie Mac, and HUD all play a counter-cyclical role of providing liquidity to that asset class. So that's sort of, if you were to rank order who's got the problems today and who doesn't have relatively the same problems, it would go starting with hospitality, then go to retail, then go to office, then go to industrial, and then go to multifamily. And quite honestly, the availability of capital is all lined up right along that. So if you need either equity capital or debt capital for a hotel today, good luck. If you need equity capital or debt capital for a retail center today, good luck. There's some, but not a lot. Office, there's a little bit more. You get into industrial, there's actually an appetite for it, and you get to multifamily, and there's still plenty of liquidity in the multifamily market.